We are so back. We're back, baby. We get an IPO coming. Chime, the B2C bank that's not a bank. They're not a bank. I can't say they're a bank. But Chime, what do? They serve everyday working adults making up to 100,000 who live paycheck to paycheck. And they're not trying to serve everyone. They're built for the 70% of Americans who don't keep high balances and have been underserved or straight up penalized by traditional banks. That was a quote I just ripped from the pod I did with Matthew Newcomb about a year ago. He's the CFO of Chime, and he came on the Run the Numbers podcast. I'm excited for this one. I dove deep into their S1, and you're going to learn about the company that is enabling, 8.6 million active members a year. So quick stat on that. In 2024, Chime branded debit card swipe volume was only surpassed by 5 issuers nationwide. That's a lot for a company that's not actually a bank. And the tagline I made up, Chime gets paid when you swipe, not when you stumble. Okay, let's rip through this one, folks. 2024 revenue, $1.67 billion. So growing 31% year over year at scale. And that 1.67 billion, that's what they actually get to keep to run the business. Remember, there's a big throughput number that we're going to get to in a second, but that's the actual GAAP revenue. And it's mainly swipe driven, not interest bearing revenue. Their purchase volume, which is the big number I referenced, 115.2 billion, which is growing 27% year on year. That's the total throughput, which demonstrates scale and the frequency of user engagement. The revenue, as I mentioned, 31%, it's growing 4% faster than purchase volume. So that would suggest to me an increased take rate at scale, or they're having additional product adoption, which we'll talk about later. Active members, 8.6 million, which is plus 23% year over year. They say they've only penetrated 5% of their total addressable market in the US. There are about 330 million people in the US, and about 70% make up to $100,000 a year. So that seems to check out. And an active member is defined as a member who completed a money movement activity in the last calendar month. So they're very much a MAU or DAO driven business, monthly active user or daily active business, because they are the bank account that payroll goes into, and they want to be the top of card in your wallet. Primary account relationships, 67%, defined as either 15 plus card transactions or a direct deposit of $200 plus in a given month. And this is the holy grail for them. As Matthew Newcomb said on the podcast, Chime's "you trust us with your paycheck" moment is when direct deposit hits. You don't just like choose a bank willy-nilly to deposit your payroll. And that makes you sticky. Average revenue per active member in Q1 of 2025, they had $251 on an annual basis. So that's annualized. That's quarterly revenue divided by active members times 4. Average revenue per active member in Q1 of 2025, it was $251 annualized. That was just the quarterly revenue per member. Average revenue per active member in Q1 of 2025, it came out to $251 if you annualize that. And transactions per member in Q1 of 2025, it was 54 per month. So like we mentioned before, Chime is the top of wallet card for members. This is the metric that proves it. Gross margin, this one blew my mind, 88%. And that actually includes transaction processing, bank partner fees, card and ATM network costs, and net of volume-based rebates. Very important. Adjusted EBITDA margin. In Q1 of 2025, it was 5%. And nothing really sketchy here, mostly standard share-based comp and non-core cleanup. Net income, Q1 of 2025, $13 million. Just squeaking by, baby. 2% margin. About as thin as those debit cards. Technically profitable, but very, very thin. Public market investors will want to see this leverage improve. Their transaction margin, 67%. This was actually down from 79% year over year, and it's how much they make on average per transaction when a swipe occurs. And that's because they have this new product called MyPay, and it juiced their revenue, but it also juiced their credit losses, bringing down transaction margin. So a story there. Net dollar transaction profit retention on a trailing 12-month basis, 104%. Just think about this as like a swipe economics version of net dollar retention, which captures growth in per user transaction volume, margin gains via Chime Core, churn offsets, which hey, it's basically telling us older cohorts are getting more profitable, not less. And they were on the Dallas Mavericks jersey. You can see Luka there, but no word in the risk factor section about that horrible trade. $33 million over 3 years for Mavs jersey patches. You can do that when you're approaching $2 billion in revenue. and growing like over 30%. So yeah, you can buy whatever jersey you want. What they do, Chime is not a bank. They just look like one from the front. So technically, Chime is a consumer fintech platform that wraps intuitive UX and UI product features around traditional banking infra. So behind the scenes, FDIC insured bank partners like the Bancorp Bank and Stride Bank hold customer funds. They issue cards and manage regulatory compliance. So think of like a local bank that maybe like your grandma uses, like my grandma uses Dedham Savings Bank or Roxbury Savings Bank. They partner with those banks who want to lend out money, but don't have the marketing dollars to compete with larger banks to go out and chase that portfolio of dollars. So Chime owns the customer relationship, the product roadmap, and the experience from mobile app to customer support. They are indeed the full stack front end, the program manager, and the brand. The banks are the balance sheet. And so that's where it's a neat split because banks do what they're good at, lending and compliance, and Chime does what it's good at, product marketing, fraud mitigation, right? Because they're a tech company essentially. And so the model is asset light, capital efficient, and importantly, does not require Chime to hold deposits or underwrite credit risk directly on their balance sheet. So if you zoom out, the structure is born out of a decades. If you zoom out, this structure is born out of a decades-long trend in U.S. retail banking. The top 4 banks now hold over 50% of domestic deposits, largely through consolidation and branch sprawl. For small and mid-sized banks, partnering with a tech-forward platform like Chime is a way to tap into new deposit flows without spending big on consumer marketing or product development. So they can scoop up portfolios of consumer deposits at scale. So for Chime, it means scaling without a charter, which is very costly. Chime is a product of a banking system that consolidated power at the top and kind of hollowed out the middle. Small banks can't afford to compete on customer acquisition, so they rent Chime's front end to get access to deposits, which they then lend out off their own balance sheet. We're not a bank, but we act like one play, has helped Chime become the number 1 brand for direct deposit switches among adults earning up to $100,000 annually. So, quote, up to $100,000 annually. This phrase is mentioned 29 times in the S1 filing. Yeah, I did the Control F search. That's not just slick branding, it's a distribution muscle paired with a real pain point. Traditional banks do not want the low balance consumer, but Chime built a business around serving them profitably. So the TLDR on this, Chime owns the customer, builds the product, takes the fraud risk, and the partner banks, they hold the money, they issue the cards, and they stay FDIC compliant. Let's dig into how Chime makes money. As Chime CFO described to me on the pod, neobanks might all look similar on the outside, but under the hood, there are a few tried and true ways to make money in this game. Here are the 4 most common models. So the first is lending/spread. You act like a traditional bank, you take deposits, you lend them out, and you earn the difference. The second, subscription fees. You charge users for premium tiers or bundled perks. The third, payments or interchange. You earn a cut of every card swipe. And number 4, float income. Park customer deposits in interest-bearing accounts and pocket the spread, which only really works when rates are high. So some neobanks try to do all of these, but most lead with one. They make the main thing, and Chime is an interchange business at its core. They're firmly in that number 3 category. And that means the lion's share of Chime's revenue comes from card payments, specifically the small fee merchants pay every time a Chime member swipes their debit or credit card. The interchange rate is actually set by the card networks, Visa and MasterCard, and then it's regulated by the government under something called the Durbin Amendment. So here's the simplified flow of who gets paid. The merchant pays the interchange fee, the card network takes a cut, and the issuer, usually a bank, takes the biggest chunk. Chime, through its partnership with banks, like we mentioned, the Bancorp and Stride, gets a meaningful share, even though it's not technically the issuer. They still get a healthy VIG there. And this works because Chime is the one doing the heavy lifting, right? They have to build the app, they have to acquire the users, they have to run fraud and support, and then the banks handle the regulatory plumbing. So it really is an elegant asset-light model, but it only works if 2 things are true. You have to keep top of wallet status. So like we said, in Q1 of 2025, Chime users averaged 54 transactions per month, mostly on non-discretionary categories like groceries, gas, and utilities. So you're always pulling it out of your wallet, the first thing you pull out to pay with. And number 2, you keep costs low. Chime's digital-only structure means no branches, and 68% of support tickets are resolved without human interaction. So between 2022 and 2025, they cut support costs per user by 60% and reduced fraud losses by 29%. And unlike fee-driven models, maintenance charges and overdrafts, or subsidy-based growth like the buy now, lose later, Chime's monetization engine is really built on trust and usage. So if you get a customer to route their paycheck to Chime, a move they don't make lightly, you win recurring swipe volume and the right to cross-sell higher value products like Credit Builder, MyPay, or Chime Plus. And so that's why they don't charge overdraft fees. That's why they don't need to push subscriptions. Chime's incentive is aligned with the member. They win when people swipe, not when they slip. So here's a quote from the S1. The increasing focus on the wealthy customer had led to a two-tier banking system in our country, and the majority of Americans found themselves in the lower tier with a banking relationship that profits by penalizing them. Again, this isn't a small subset of people. 75% of Americans earn up to $100,000 per year. This is the heart and soul of our country. So how do we get here? The reality is that most Americans don't have large deposits. 2/3 live paycheck to paycheck, and far too many are considered unworthy in terms of credit quality. For traditional banks with balance sheet driven lending business models and costly physical footprints, this means most Americans are undesirable to them. The only way to serve them profitably is a heavy focus on fees. So that's from their S1 filing. Let's talk unit economics and throughput more specifically. So their model hinges on volume, retention, and cost control. And their metrics tell the story of a neobank that's figured out how to scale without melting its servers or its margins. Here's what stood out to me. Active members, 8.6 million, growing 23% year over year. Primary account relationships, 67%. Defined as members who route their paycheck or use Chime for 15 plus transactions a month or a $200 deposit. RPAM, average revenue per active member, kind of like ARPU, $251 annualized, which is up from $231 in Q1 of 2024 a year ago. Purchase volume, $115.2 billion, up 27% year on year. Transactions per member, 54 a month on average in Q1 of 2025. Non-discretionary spend, 70% of purchase volume actually goes to essential categories, which makes it more economically resistant to shocks there, which is good for recurring revenue predictions. Product attach rate, 3.3 products per active member. Net dollar transaction profit retention, we mentioned this, 104%, meaning revenue from older cohorts actually grows about 4% each year. Support efficiency, 68% of support interactions resolved without human intervention. That's really good, 68%. AI, fraud loss rate, down 29% from 2022 to 2025. Support cost per member, down 60% over the same period. So these numbers paint a picture of a platform with daily utility. Chime isn't just an app people download and forget. It's where their paychecks land, where they swipe for gas, where they overdraft for free, and where they build credit. It's the hub. And once Chime earns that trust, read that direct deposit, and everything else will come along with it. The SpotMe, MyPay, Credit Builder, and Chime Plus, it becomes much easier to layer on. So while Chime hasn't disclosed exact customer acquisition cost figures, they do note that referrals remain their largest acquisition driver. That shift away from paid channels helped bring sales and marketing spend down to 26% of revenue in Q1 of 2025 from 42% in 2022. And if you couple that with rising RPAM, average revenue per active member, that suggests an improving LTV to CAC profile, especially as primary account relationships deepen. So Chime's been running the interchange playbook with real discipline here, but they're not standing still. So under the hood, they've been expanding their product surface area, aiming to deepen relationships and expand monetization just beyond swipe fees. And so in their S1, they said, looking ahead with less than 5% adoption in our core target market, we see an enormous opportunity to grow for years to come. Our primary account relationships uniquely position us to expand into adjacent service areas to enrich the lives of our members. TAM Expansion. We mentioned Chime Core. So this is owning the infrastructure. So in 2024, they launched Chime Core, which is their proprietary payment processor and ledger. And it's not just plumbing, it's strategic. It lends to cost savings. So it reduces reliance on third-party processors and gives them tighter control over margin. Speed. It enables faster product iteration and settlement flows. Control helps with fraud detection. Risk modeling, and compliance agility. So this is the same playbook big fintechs like Square and Stripe have run, right? Own the rails to move faster and cheaper than the incumbents. Chime Plus, it's premium without the fees for now. So Chime recently rolled out Chime Plus, a free premium tier that unlocks higher savings rates, cashback deals, and enhanced support. And so it's not monetized by a subscription yet, but it is a retention and an RPAM play. And so it goes incentivized direct deposit, unlocks perks, and then that deepens engagement. And so it also plants a seed for future paid upgrades without violating their anti-fee brand ethos. The third one, Chime Workplace. This one's interesting. Going B2B to C. With Chime Workplace, they're partnering directly with employers to offer financial wellness benefits. So early wage access like MyPay, SpotMe, and savings tools for workers. So this is distribution and stickiness at its core. They're trying to get employers to push out a lightweight benefit to workers, and Chime will get embedded earlier in the paycheck lifecycle. Remember, they want to capture that bank account that the paycheck goes to. So they're going upstream to go and get it. And it's a wedge into verticalized fintech territory. Think like a Gusto, an Even, or a PayActive. The fourth product, MyPay. And there's a bit of a trade-off here because MyPay has traction. There's a bit of a trade-off here because MyPay has traction, 8.8 billion advanced since the launch and now 12% of revenue, but the economics are really tight. So in Q1 of 2025, revenue was 64.3 million, but the credit losses were 57.3 million, which means net just around 7 million fell at the bottom. And so that expansion cost Chime 12 percentage points of transaction margin, 79% down to 67% year over year, and management warns margins may compress further as lending expands. So it's a classic fintech trade. You have sticky product, thin cushion. And the information did a story on this. And you got to hope that they find their lending footing over time. You don't figure out the equation overnight and reduce losses at scale as they hone in on who are the right customers to lend to. So let's take a look at their valuation and cap table, because Chime is taking the swipe funded road to the public markets. But what's the valuation story behind all that interchange? What are they worth? Well, first off, they're going to trade on the New York Stock Exchange. The price range and the shares outstanding have not been disclosed yet. Their last private valuation was in 2021. If you remember those times, it was peak exuberance, and they were valued at 25 billion, and it was led by Sequoia Capital and SoftBank. It was their Series G. We're going to talk about how that number has to come down in a sec. But the bankers on this, if you look at the book, lead left was Morgan Stanley, then Goldman Sachs, and then JP Morgan to round out the top line. Some hitters there. They must have some faith that this is going to be a big IPO if all three of them got in on the action. That's a leading indicator. Capitalization snapshot. So Chime exited Q1 of 2025 with 1.1 billion in cash and equivalents with minimal debt. And they've reached positive net income, but adjusted EBITDA is really thin. Like we mentioned, the IPO proceeds are likely growth capital. It's not a lifeline, and a strategic raise to fund expansion while preserving balance sheet flexibility. So in CFO speak, I would say they don't need the money, but they're smart to take it now. Cap table highlights. The principal stockholders include a who's who of growth fintech capital: Sequoia, SoftBank Vision Fund, DST Global, General Atlantic, Tiger Global. And the founders, Chris Britt, CEO, and Ryan King, CTO, still retain substantial equity and likely voting control via dual class shares. And so the exact post-IPO ownership stakes are still redacted, but founder control is essentially guaranteed. What's it worth? Early media coverage did float a 30 billion IPO valuation, but that would be nuts. That's looking way less realistic. More recent whispers in the actual math suggest a tighter range under 10 billion. So the forward valuation math, if we assume conservative 20% growth in 2025, that puts revenue at 2 billion next year. At different valuation points, 8 billion would be 4x forward revenue, 9 billion would be 4.5x forward revenue, and 12 billion would be 6x forward revenue. And that would imply Chime is lining up somewhere between Robinhood and Nubank, not priced like SaaS, but above typical lending or insurance models. And so the TLDR here, and I've written about it before in a piece called the FinTech Power Rankings on mostlymetrics.com. Not all fintech revenue is created equal. So on the multiple ladder, interchange sits above float, lending, and insurance, but below SaaS, payments, in. So the TLDR here, not all fintech revenue is created equal. I've written about this on mostlymetrics.com. It's a piece called the FinTech Power Rankings. So on the multiple ladder, interchange sits above float, lending, and insurance, but below SaaS, payments, volume, AUM, and trading. So Chime's in the middle of the fintech pack, not a bank, not a Stripe, right? So if Nubank's trading at 10 to 12x forward revenue, Robinhood is trading at 5 to 6, SoFi closer to 2 to 3. Affirm actually right now is trading, I think, close to 6 to 7x forward, which is really rich for a buy now, pay later, because you got to figure that if things go well, Chime trades above that. But Chime wants to pitch as a high margin, low capital consumer platform, but public investors will likely price them off recurring swipe based revenue and build in a discount for regulatory exposure and lack of product diversification at this juncture. So what's on an investor's mind? Swipe or die, revenue concentration. Chime earns 90% of its revenue from interchange, about 90%. And that's efficient, but it's fragile. You got regulatory risk there if any moves happen to the Durbin Amendment or cap interchange fees get hit directly. Behavioral risk. Will wallet rotation or spend slowdowns hurt more when swipes are your only engine? And a diversification gap. So no lending, no float, no paid subs yet. So what's plan B if swipe economics compress? Number 2, banking without a charter. Chime isn't a bank, like we said, it just plays one on your phone. All deposits and card issuance are handled by partner banks. So if one of those banks exits or banking regulation tightens, Chime's core plumbing breaks. And so Chime earns issuer economics, but it doesn't control the rails. So the investor concern there, this is a platform risk, not just a product risk. Unit economics Blackbox. So Chime's S1 is super slick on RPM and user activity, but it's kind of opaque, if I'm being honest, on fundamentals. So they do not disclose an interchange take rate. I'd want to know that. There's no visibility into Chime core cost savings, and there's no cohort level LTV CAC to break down, right? What's the lifetime value of a user and how much does it cost you to get them? So my concern would be you can't model profitability per user and you can't price a stock with confidence. Margins still look startup-ish and they're getting squeezed. So despite almost $1.7 billion in revenue, Chime posted just $13 million in Q1 net income, 2% and 5% in adjusted EBITDA. So more telling is transaction margin dropped from 79% to 67% year on year, largely due to MyPay's slim risk-adjusted returns. So is this margin profile sustainable, or are they just getting dressed up for the big dance? Founder control and governance. Chime is pursuing a dual class structure, which likely gives Brit and King long-term control. And it means limited shareholder recourse even if performance lags. Proxy advisors and governance-focused investors probably won't love that. And so will it be founder-led forever no matter what the scoreboard says? And then a cap table shadow of sorts here with liquidity and dilution. So we don't know how much secondary liquidity insiders took in that 25 billion Series G. Hopefully they secured the bag. A likely option pool refresh could add dilution right at the gate. And so you got to think, are new public shareholders signing up for growth or for cleanup? So the final word here, Chime's S1 is more than a fintech filing. It's a referendum on whether a consumer business can scale and trust, swipe economics, and software DNA alone. And they aren't trying to reinvent banking from the balance sheet up. They're building a lightweight front-end machine that runs on behavioral loyalty. And so far, the numbers say it works. But public markets are a different game. Interchange is a tightrope. And once you're public, alignment gets stress tested. So investors will ask, is this a payments platform with SaaS margins or a consumer app with swipe risk? The answer will determine whether Chime becomes a Stripe of neobanks or the Affirm of debit cards. So if you like this S1 breakdown, please share it with a friend. Give us 5 stars. We're almost at 100 on Spotify, so I can finally tell my mom. And thanks for rocking with me. I hope you enjoyed this, and hopefully there'll be more IPOs this year.